Hey guys, welcome back to RWM Finance. So in today's video, I wanted to talk about the term asset allocation. A lot of new investors feel that the investment account that they pick is what determines their level of risk. But this isn't true. What determines their level of risk is the amount of risky or non-risky investments within that account that you own. That is what determines your level of risk. So what is asset allocation? After recently giving y'all the steps to investing in stocks, I felt the need to explain a few more investing techniques and strategies to assist y'all in your individual journeys. Asset allocation is the term for the mix of different asset classes that you own within your portfolio. Now, asset classes are just different types of investments. If you own more risky investments than non-risky investments, then naturally you are going to take on more risks. So the three primary asset classes are equities or stocks. People will call these equities because you are purchasing equity in a company. The next is fixed income or bonds, and lastly we have cash. That is actually the order of risk level that those asset classes fall in. Stocks are usually higher risk than bonds, and bonds are a higher level of risk than cash. Cash is considered the safest investment, but I don't really agree with that, because if your money isn't growing, then I don't really feel that it is safe because of inflation, but I don't really want to get into inflation, so I'll save that for another video. Now, the percentages of those asset classes within your portfolio is what determines whether your portfolio is considered conservative, balanced, growth, aggressive growth. Now, if you remember which asset class was the riskiest, which I hope you do, you can probably connect the dots that an aggressive growth portfolio will contain more stocks or equities than a conservative portfolio would. In fact, aggressive growth portfolios typically have 60% of their investments in stocks, while a conservative portfolio will only have around 15%. Now, the riskier the portfolio is, on average, the greater annual return percentage is. But there are also some drawbacks to having an aggressive portfolio. An aggressive portfolio will usually have the highest returns compared to other types of portfolios. However, it can be very volatile, meaning that it will go up and down quite often, and it will also go up and down in larger increments. Now, for a younger person, aggressive portfolios are a good idea because you have time to recover from the low points, knowing that the market will climb as it always does. The thing is that you are the only one that can make the final decision. You have to pick a portfolio that is based on your financial goals and personal circumstances. Not everyone has the same level of risk tolerance, so not everyone will have the same portfolio. You need to put together an asset allocation that is based on your need for growth, your tolerance for risk, and the amount of risk you can afford to take. Like I said, if you are young and you need a portfolio style that will grow, an aggressive growth portfolio is probably the way you should go. But like I've said before, I'm not a financial advisor and I'm not trying to tell you what to do. I'm just trying to present you with some information that you might think would be useful. Focus on this throughout the time that you are investing. Markets will go up and down, and there will be good years and there will be bad years, but this is all a part of investing. But the more disciplined you are and the more you understand what you're investing for, the better off you'll be. Like I said in the earlier video, the rich plan for 2 or 3 generations ahead. Don't worry about the everyday ups and downs of the market. Focus on the goals you're wanting your portfolio to achieve in the long term. But make sure your investments are set up for long-term growth. So I wanted to share with y'all some information about diversification and asset allocation because there can be a little confusion between the two. So I just wanted to clear some things up so no one is left confused. Both of these are similar in that they are basically telling us to invest into multiple things instead of just one. However, diversification occurs within the same asset class, while asset allocation occurs by spreading your investments within each asset class. So you can diversify within stocks or bonds, but you allocate your assets between stocks and bonds. I hope that made sense and might have cleared up some things if any of y'all were confused. Well guys, I hope you enjoyed this video. If you did, go down, give it a like, and subscribe to the channel below. Also, if y'all have any questions, please post those in the comment section, and I will personally try and respond to each and every one of y'all's. Follow us on Instagram at RWM Finance. Remember to check out the list of books in the description bar below. Also remember that I post videos every Monday, Wednesday, and Friday, so tune in for the next one. As always, thank y'all for watching, and I will see y'all in the next video.